Now let's get an early look at what we can expect then from the local market. Cameron Peacock joins us from IG in Melbourne now. Cameron, good to see you there. Yeah, what did you think of what we saw overnight on Wall Street? Those losses, you know, it was a pretty choppy session, wasn't it? And in the end, the losses for the three major indices there.
Yeah, good morning, Bridie. That's right. Look, you know, we are looking at a slightly softer open for our market today after those modest losses on Wall Street, which you've just spoken about. Yesterday, of course, after that Greek debt deal news, we saw our market rallying, finishing up 0.7% at around that 44.56 level. But unfortunately, we're looking at a slight easing today, currently calling the market down, you know, about 11 points or 0.25% around that 44.45 level. Now, you know, we did see European indices have a modest bounce last night. I think we had the FTSE up 0.2%, the DAX up about 0.5%, the CAC finishing fairly flat. Not a huge, you know, rally or, you know, move higher on the back of that Greek debt news, but perhaps because it was largely expected and, you know, maybe already factored into pricing. And so attention quickly did turn to the US and those fiscal cliff negotiations. And as you just spoke about, we've just seen the US markets finish modestly lower. We had the Dow Jones selling off in the last, you know, half an hour of trade to finish down about sort of 90 points. I think in the end about 0.7%. We saw the S&P down about 0.5% and the Nasdaq down about 0.3%. And, you know, those losses seem largely attributable to, I guess, renewed squabbling between the Democrats and the Republicans. And, you know, from what I can tell, a lot of it revolves around these, you know, a lack of progress on tax talks. And we did have the Senate Majority Leader, Harry Reid, the Democrat, come out saying he was disappointed with progress. And it does seem at the moment that, you know, a lot of the issues revolve around this top 2% of income earners. That they're those that are earning over $250,000 per annum. Now, the Democrats want to extend the Bush-era tax cuts to all income brackets except that top 2%, where the Republicans want to extend it for all income brackets, including that 2%, that top 2%. And that seems to be the real sticking point at the moment. And it seems that until we get past that issue, that you know, they're not going to be able to move on to the other side of the equation and deal with some of these other issues like cutting spending and entitlements. So, you know, on the basis of you know, those stalled talks, we are looking at a softer open today.
It was interesting though, wasn't it? Because the US dollar was stronger and many were putting that down to the fact that there was some better than expected economic data out of the US overnight in terms of house prices and also consumer confidence.
Yeah, that's right. I read that as well. I mean, we did see housing prices rising for the 6th consecutive month. I think we had consumer confidence coming in at 73.7, I believe it was, the highest level in 4.5 years. Durable goods orders were fairly flat. Economic data in the US has, by and large, been, you know, pretty positive over the last couple of months. But, you know, as one analyst I was reading this morning suggested that until we get this fiscal cliff issue sorted, stocks are just going to muddle along. And I think that's what we're seeing at the moment. Stocks are certainly very range bound at the moment. We've got the US dollar sort of trading in that sort of 80 to 81 bracket. It was a little bit higher last night. We did have the likes of gold a couple of dollars lower. We had oil prices down about 0.5%. We had base metals surprisingly up a little bit last night. So it was a real mixed bag at the moment. And I think investors are really just a little bit confused as to where to next. And as I said, I think the thematic over the remainder of this year until we get a fiscal cliff resolution is just going to be for stocks to bounce around current levels.
It was interesting, the OECD coming out with its latest global outlook update and certainly talking about global growth among the richest nations, indicating that that's going to be weaker and also saying that there is the risk of a new major contraction that can't be ruled out, and really blaming the Eurozone crisis for that. What do you think? I mean, there was a little bit of optimism on the Greek deal overnight, but really, do you think that investors are that convinced that the crisis has been sorted?
Certainly not. I mean, I'm certainly not convinced. I think your previous guest or the previous interview hit the nail on the head. All that we've really done is kick the can down the road a little bit further and kept Greece alive for another, you know, 6 to 9 months. I mean, there is a real fear out there that Greece could be back again in 6 to 9 months renegotiating a new deal. So, you know, and all that the Euro policymakers have really done in recent times is negotiate one side of the equation, and that's the debt side, looking for some debt forgiveness and helping ease the debt burden. They haven't really addressed the structural issues in Greece or wider Europe, and that's growth. I mean, you've still got, you know, in the likes of Greece and Spain, just massive unemployment levels, you know, 40% plus in I think the under 30 bracket. So, you know, until some of those structural issues are resolved, you know, you can't see Europe actually growing. All they're doing at the moment is cutting debt, and that's not going to be a long-term solution, unfortunately.
All right. So just again, remind us the call for the open on the benchmark from IG.
Yeah, look, at this stage, down about 10 or 11 points, about a 1/4% around that 44-45 level.
Great. Thank you as always, Cameron. Good talking to you.
Thanks, Bridie.
All right.